Kristina, when you talk to clients in recent days and weeks through the month of January, what's been the main concern on their minds?
There's been a lot of concern over the U.S.-China trade wars. Where are we going, and are we going to see things get worse, not better, especially given that we have this March 1st deadline hanging over us like the sword of Damocles?
So that's all there in the background. It seems like it's taking a little bit of a back foot to earnings at the moment, and also the high frequency data that's coming out now sort of after a little bit of a pause. Today again, factory orders down 0.6 and capital goods, non-defense ex-air down 0.6. What does that say about the fundamentals of the economy?
Well, it shows that in general what we've seen, if we look at the totality of the data, including this, is that there's a mosaic, and there are some areas that are doing better than others. We can look at the jobs report as certainly a very strong area of the economy. Certainly the consumers are doing well. We're seeing wage growth there, but certainly there are spots of weakness. And the question is it going to get worse from here, or is it going to be relatively stable this year? And a lot of that, of course, depends on the global economy and where we go there.
Kristina, good morning. The Fed appears to be on hold, and according to Neil Kashkari, Mr. Powell's coming around to the idea of being on hold for really quite some time. Are you a buyer or a seller of the dollar?
Well, in this environment, you should actually try to stay away from the dollar, because what we've seen over the last several years is that the dollar's strength really is very dependent on expectations about Fed policy. And so if we expect, which seems likely, that the Fed is quote unquote patient this year, takes its foot off the accelerator, we're likely to see other currencies show greater strength than the US dollar, all else being equal.
The all else being equal bit is quite interesting, because do you think other central banks can really do anything to tighten policy in this environment? I'm just wondering, like, if you expect anything from the ECB now, whether you expect anything from the BOJ, because if the Fed's done, presumably they're done.
Well, the Fed, even if the Fed is done, we haven't necessarily heard from other central banks yet. And there is this very significant risk that we have a more hawkish ECB president when Mario Draghi's term ends in the end of October. So there is that potential there. And of course, it's not just about central bank action, it's about expectations about action. And so if there is expected a more hawkish ECB president, we could see the euro move up in advance of that.
What does that all mean for US stocks? Obviously, you know, the bulk of your investors and the people that you talk to are invested in US stocks to some extent. And we've seen a bit of a mixed earnings season. What do you make of it all?
Well, the earnings season has been relatively good. Of course, there have been pockets of weakness, but the question is, what are we going to see going forward, right? And what we've seen thus far from a lot of the earnings reports and earnings calls is that there's expected to be a continued modest deceleration, that there are some headwinds facing many companies in the U.S., particularly those that rely on multinational business, that derive a lot of their revenues from outside the U.S. So a lot is very dependent on where the global economy goes this year. And I think that's one reason why we saw the Fed say that they're going to be patient, that they may take their foot off the accelerator, because quite frankly, a lot of the data in the U.S. is very positive. And the Fed is reacting, at least in part, to global economic weakness. And they said as much last week in the announcement in the press conference.
So take tech stocks, for example. We have Alphabet out after the close today. Can you take tech stock as one bundle now, because most of them have some, if not, you know, important exposure to China? Do we then sort of write them off for now, put them on pause?
Well, it depends on your time horizon, because many of them look very attractive. So if you have a long enough time horizon, this is a good place to invest. And quite frankly, we could see a lot of the issues facing these stocks go away relatively quickly. For example, if we do see a fast resolution to the U.S.-China trade talks.
Kristina, what's your level of conviction in these markets at the moment? A lot of portfolio managers continue to worry about what is going on around them. You've already talked about what's happening with the Fed. You've talked as well about what is happening with the trade story. We've got a macro story in Europe that looks like it's slowing down. And then, of course, we've got Brexit and Italy and all those other things to worry about. What is your level of conviction in the direction for these markets?
Well, I think so much of the direction in markets is dictated by the central banks. That's what we've seen really for the last decade. And so that if we have accommodative central banks, that provides a very nice support system. Now, that doesn't mean that there won't be headwinds, but it certainly helps. And so I have a very high level of conviction over the long term that investors need exposure to risk assets to meet their long-term goals.
Is the cycle now going to be longer because of that accommodation that we are getting from the Fed, etc.?
We could very well see this cycle extended because of this accommodation. This has been an unusual recovery really from the start. It began very artificially, then it became much more organic, and now it's being given something of a second life, an injection of energy created by what looks like further central bank accommodation. And that doesn't mean the Fed has to cut rates, as some are expecting, by just staying on hold this year and offering the potential of tinkering with balance sheet normalization and perhaps dialing that down. That's going to be powerful.
Kristina, prior to this, you've worked at Allianz. You've also worked at PIMCO Funds. I have to ask your reaction to Bill Gross's retirement and the impact that he had on you as somebody who would have been thinking about rates a lot.
Just an incredible investor with a storied career, and hats off to him for all he's done for the industry.
And then on that note, where do you anticipate rates going?
So I would expect that we will still see the Fed raise rates this year. I know that's not perhaps a mainstream viewpoint, but we could see the Fed raise rates one time, possibly even two, but it probably looks more likely at this juncture one. But keep in mind that what we saw in the jobs report last week was that wage growth continues to be relatively strong. We could see a point, especially with tariffs impacting input costs, and we could see a point where core inflation goes up and the Fed doesn't have the ability to be as flexible. But certainly right now it has the ability to be flexible, so I would expect, and this is an educated guess, perhaps one rate hike, maybe two this year.